Good day, everybody. This is Jim Kenny for the weekly update for OptionProfessor.com for today, February 22, the year 2019. As I always say, that past performance is not necessarily indicative of future results, and short-term trading and option trading do involve substantial risk of loss and ergo are not right for everybody. So do check in with your clearing firm, your broker, and also your good common sense on what, if any, transactions are appropriate for you. By way of introduction, for the new people coming on board, I'm Jim Kinney, and I'm a graduate of Boston College. I've been in the investment arena for decades. I do live seminars throughout the nation for decades, and so I have educated thousands upon thousands of people coast to coast on the uses and risks of options, using options for hedging purposes to protect against market declines or market advances, and also to use them as a limited risk speculation and also as a cash flow creating strategy. So again, I am going to share with you today, as always, my views, my opinions, and if you have any questions, of course, you can shoot me an email at at gmail.com, and I'll be able to help you with any specific question you might have, if I can help you at all. Okay. All right. Let's get right into it here. As you can see on the screen, we are up strongly again today. They tried to roll the market over on Thursday. Sometimes Thursday is a rollover day, but it's right back up today. I was listening to the gentleman from JP Morgan, who was on CNBC this week, and from his analysis, he does think that the market has more legs to it. And again, the fact that it went right through the 200-day average and has been trading above it is very constructive for the market. Some of the Elliott wave people thought that the market may peak out around 2,800 on the S&P. Let's take a look at 2,800, but they've raised their target to the highs of 2,940. So it is possible, could run all the way up to the highs of 2,940 if we can clear this hurdle, which is right around 2,800. Clearly, the market does have legs, and clearly the China deal getting resolved is getting, and the time of year. You know, there is some cyclicality, whatever that word is. I just tried to get out, meaning the cycle of this time of year is constructive, because people in the beginning of the year, they put their IRA money, their pension plan money to work, blah, blah, blah. At the end of the year, when liquidity was rather lousy, they hit the market pretty good. As you can see from that chart, we went down to 2350 area during the end of last year because of what were the reasons? The reasons were the China deal was supposed to be maybe more tariffs and really kill the economy. And of course, the Fed at that point was hiking in December, and there was talk that they were going to continue. Those two cards have been dealt, and those two cards have changed in that the Fed is now in the pause mode, and the China deal looks like it might happen. So obviously, everybody who was out of the market, and then we hit this period of time this year where everybody is coming in, has driven the market way up. Some of the technical indicators are quite positive. You know, if you want to be bearish, but you can't be bearish if the market doesn't give you those kind of numbers. So one of the big things going on right now is the advanced decline line. That's the number, the cumulative number of advancing stocks versus the cumulative number of declining stocks, and that hit an all-time high. There is no real record in history that we've been able to find where a bear market starts when the advanced decline line is that high. So you can't, Marty Zweig, God rest his soul, always said, don't fight the Fed and don't fight the tape. And that's a good thing to stick with. So the tape has turned positive. It could have problems here at 2,800. But I do have a suspicion with the advanced decline line and people being very comfortable. You know, again, I'm a very much a watcher of the VIX. Let's take a look at the VIX in a second. But can you see, if we break through this 2,800 resistance, the next stop is the 2,940 highs. Now, at that point, you know, if there's trouble up there, then that could be a point where a rollover could occur. But if not, then obviously, you know, this market, you know, all markets have pullbacks at some point. But there's no evidence of a pullback right now, that's for sure. Again, the 2,800 is still a resistance because we're still underneath it. But the VIX, you know, the comfort level is at 14. Now, again, comfort level can be a danger sign, meaning everyone is we've come very fast, very far, and now the VIX is showing that everyone's very comfortable. And of course, when the market, when the people are very comfortable, sometimes that is a prelude towards some kind of a turn. So again, this neighborhood in the 14, 15 area, again, is a low area. And if the market turns out of here and if the market rolls over, again, there's a lot of people that are very comfortable. And this could be a situation where this could be a high point as well based on the VIX. So again, if the VIX starts trading between 10 and 15, then I think obviously we're going to go up to those 29, 40 numbers. Again, this is a pretty key area right now. So that's the big thing that I saw here today is, again, the advanced decline line hitting an all-time high. Again, bear markets generally do not begin with that type of technical indicator. Again, most stocks are obviously advancing. And the breadth of the market, which is what this thing does, it tells you what the breadth is. And remember when we were running up where the FANG stocks and, the tech was pretty much carrying the boat? Again, that has changed in the last couple of months here as this rally has lifted all boats, and the advanced decline is evidence of that. With regards to, we talked about the risks, right, in the market, which brought the market way down in December. The fear of China and tariffs ruining all the economies, and also the fear that the Fed was going to be hiking. Now, what's going on right now that would be of concern? Because, there's always something out there. You can't just walk down the street whistling constantly. There is always something you have to be aware of. And right now, a couple of things to be aware of is the valuations and the earnings, right? Because again, if earnings aren't there, the stocks aren't going to go up on their good looks, right? Earnings are important. Now, the valuations did drop to 13.59, which was a very lower number. But with this advance, valuations on the S&P looking forward is at 16.27, and that's the highest since last October. Well, what happened in last October? Let's take a look, and that might give us a little bit of a pause to keep an eye on things, because again, the enthusiasm is getting very high. These guys on TV are talking positive, and these technical indicator guys are talking positive, and the Elliott Wave guys are talking positive. So the enthusiasm is there. There's no doubt about it. The question is with no earnings or lower earnings, can it keep going? Now, if you look at the valuations being this high, what did the market do in October? Well, you can see it was at the high of 2,900 at October, right? So the bottom line is the valuations are quite high. Now, the problem with that could be is that earnings are only supposed to grow, consensus is 4.2% this year. Last year, it grew over 20% because of the tax cut. Again, that's all factored in, apparently. And so this year, the earnings are supposed to be 4.2%. Hey, if they blow it out and they're way higher than that, then you justify this rally, right? But if it comes in at that number or less, then obviously these levels may be hard to sustain. And that's the only bear case you could really make, is that the valuations are rather high and that the earnings are not supposed to be robust. And if that continues, again, comparisons in the next quarter, quarter two, and the following quarter, quarter three, are going to be tough because last year's quarter two and quarter three were quite strong. So again, we are facing some headwinds on valuations and earnings year over year comparisons. And that would be the one thing that would put the yellow caution flag on with this rally, despite the fact that, again, a lot of the technical indicators are looking quite good. Let's take a look. We're at 2792. Let's take a look at the moving averages here on this. This is the S&P. And I'll show you here the moving averages on the 50-day is 2621. Now that is rising again, but it's still well under the 200-day of 2746. That's why we could get to a point where the market goes sideways. And if it goes sideways, then the 50-day can catch up to the 200-day. Now, again, if this market at 2792 ever gets back under 2740, I think that would be a big caution flag as well, because you've already got an inverted 50-day under the 200-day. And so if it gets under 2740, and then if it got under 2600, then that would change the whole landscape. But a lot of people believe that if we have drops, 2740 and 2600, 2650 will be the stopping points, and that this market will resume its bull trend. Only time will tell. You got to watch the tape, and you can't fight the tape. But right now, as we speak, the market looks firm, the numbers look firm, the technicals look good, and obviously the complacency is high. Not tremendously high, because that would be the VIX down at the lower levels. Let's take a look at the other things I will look at every week for you to get a pulse of the market. The transportation average. Right now, 43. Okay, so the market's up big, but the transports are rolling over. That could be a caution flag. Let's take a look at what it looks like. Yeah, you see, it did not go up and take out that 11,000, and it's nowhere near its all-time high. That's a caution flag to me. Why? Because we're up at 2,800, equivalent of about 11,000, in my view. And we're not taking it out, it's rolling over. Now, obviously, rolling over one day does not make a trend, but it did come off from it came off 50 points here from the high today. So let's see if this transport next week can get back on the bicycle and take out this week's high. You see what this week's high are right in there. Let's see if it takes that out. If it starts rolling over under 10.5, let's look at your 200-day average on it. I think the transports are very important, because if they give up faith on shipping goods and services and people, it's a situation where, I don't think that's a good thing, because the transports and the Russell led us up. The transports and the Russell could lead us down as well. So keep an eye on it. You see the moving averages are at 10, 5, 6, 4. They're very inverted, right? So that's not a great thing, technically. But right now, we're still above it. See, we blew through the 200-day. So watch the transports next week. If they start getting under 10.5, I think that could be, and if the S&P fails at 2,800, that could be a signal that a correction could occur. Don't forget, the fact that they're negotiating a China deal is no secret, right? It's on CNN and Fox News and every other news, right? So we all know it's happening, and you don't think people are bidding the market up based on part of that? Of course they are. And so basically, if that's a buy the rumor, sell the fact, that will be interesting to see if that occurs as well. Again, you can't fight the tape. The tape has been very strong, but you also have to be aware that the tape could have cracks in it. And the markets, the numbers speak for themselves. The 200-day average, I think, is very important. And the 200-day average, I believe, is at best stabilizing, if not still declining. So we have to keep an eye on it. And so, again, the market on the transports getting back under 10.5, that might be a little bit of a caution flag. Let's look at the Russell. That's 2,000 stocks. A little broad-based, more than the S&P 500, right? All right, so let's take a look there real quick and see what you got. All right, we're up 13, so that's not bad. And again, it's on the high. And yesterday it was down 6 or so it's made up the 6 and made some more ground. Let's take a look at the chart here. Yeah, I think it made a new high on this move, right? So that's not a bad sign. It did take out this reaction. Of course, it's nowhere near the high, right? So it's nowhere near up here yet. So we'll have to see how that works out. And let's see what the moving averages are telling us. I believe 1,600 area is still pretty good resistance. That would be like the 2,800 area on the S&P. All right, so where are you? You're at 1587, so it's right on the 200-day. It hasn't really blown through very much. It's right there. And so if next week or the week after we start losing altitude, then you'll know that this rally to 1,600 or 1587 200-day average has failed. Up until that point, though, again, the legs look good. The advanced decline looks good. The VIX is getting into actually an area where people are very comfortable with owning stocks. And of course, we still have more time on the clock on the cycle where the stock market has a good time. Generally, the cycle ends around April, I think. And then from May to October or something, I believe that is when the market is in a cycle, generally speaking, where it's not as robust. So it could coincide with March, April with regards to this rally. And as we go into March and April, if we're really extended, I would probably consider some protection. Again, when the VIX is low, what can you do? You can do a couple of things if you get nervous. One is you can buy some puts. What does that mean? You look at your stocks and then you look at some puts. Obviously, you got to look at all the different dates. Sometimes you can buy a put going out a year or two that is not that much more money than buying one for 6 months. And so obviously, since you're buying insurance, if insurance cost, just use a number, $100 for 6 months, and 180 bucks for 2 years, maybe it's not such a bad idea to extend your insurance out to 2 years, because when you buy the option, you really don't want it to expire, and obviously more time is more better as far as the insurance is concerned. So price out all the options nearby, 1 year out, 2 year out, and get an idea of what these insurance costs will be. Because again, when you're buying put insurance, the longer you have it, the better. And if the cost is not that much, again, it's not bad to throw a little bit more money in to get a lot more time on your protection. So that's one thing, the married put. The other thing would be the collar strategy. If you think the market is rich and the market is run up, probably the calls are going pretty fat. So you go a little bit out of the money and then you sell a call. And that puts a cap on your position at that level. You're agreeing to sell your stock. And basically, you take that premium and you buy a put underneath. So you've bracketed your equity. And in that case, you've got insurance that's been bought by the cash flow of the call. And so if the market goes stable, one offsets the other, and you're still in the same position you were. And then, of course, if the market goes in the tank, then obviously you've got put protection underneath. I suggested people investigate that when Amazon was at 2050. Let's put Amazon up there so I can show you an example of what I was talking about. Again, you have to, there's many factors to determine whether that strategy is appropriate for you. But certainly if you're trying to hedge or protect your position against market declines, and it does have a market decline, it could be very appropriate. Let me show you what I was talking about here. Okay, we're up at this is Amazon. We're up at 2000 here back in October, right? And we got a double top. Now this market has a moving average at that point down in the 1500s. So the moving average is way down here and the market's up there. Whenever you get your stock above or below the 200-day, 20, 30, 40, 50% above, that's extended. And when you're extended, the risk is that it's going to come back towards the moving average. Well, when we're up at over 2000, again, and you're looking at the moving average down at 1500, which is down here, you're looking at a situation where if you sell a call at 2100 and buy a put at 1900, let's just say the numbers offset each other, you've got insurance at 1900 and you still got upside to 2100. Now, the cash flow off the 2100 in this example, theoretical, is going to pay for that 1900 put. Okay, what happens next? What happens next is we go down to 1300. Well, if you've got to put at 1900, that's 600 points of protection. If you have 1,000 shares of it, let's say you only have 100 shares, that's $60,000 that were protected on that position. And you didn't even pay for it out of pocket because, again, it came to you in the form of cash flow. Now, it did limit your upside to 2,100, but for gosh sakes, it had already come from 1,400 to 2,000. Limiting it to 2,100 doesn't look that bad in hindsight, of course. And again, the trees don't grow to the sky. So that's an example. Again, theoretical, rough math, but it gives you the concept, and that's all I'm trying to give you right now. If you have any specific questions on these things, again, shoot me an email. And again, if you have any friends or associates that are in the market and maybe they got whacked in December and they had no idea how that works, because when you trade on your own, they're not going to call you up with ideas. The reason you're paying nothing in commission is they're not giving you any advice, right? And or input. And so you're on your own. So you're going to have to go out and do your own homework, do your own research, be your own expert, be your own Buddha. Right. So the thing here is if you're going to do that, try to know how to not only try to make money with things, but how to try to offset risk as well. So again, if you have any friends or associates that could benefit from this, again, OPTION Professor, PROFESSOR @gmail.com. And I'll try to answer any questions that you might have. Also, again, this broadcast is free of charge every week. You can tell them about the link, and they could tune in and get an update on things weekly, just as easy as you are today. All right, so let's keep the ball rolling here and see what's going on as far as other things. Amazon's up today. If you notice, it's hanging around the 200-day average, so it's stable right around here. It's got to hold this 1600 area. If it starts breaking under 1500, then it's going back in the soup. Again, it's a company that has very high valuation. PE ratio, again, when I was talking about hedging up at 2000, the PE ratio was over 100. Now it's down at 81. Don't forget, valuations are important. It's what they pay for $1 of earnings. And when you're over 100, like Amazon was, you can't announce that your sales might be dropping a little bit, or you can't announce that some companies like Whole Foods, your brick and mortar stuff, is costing money. People don't want to hear negative news when they're paying through the nose for your stock. And again, when you're over 100 on the P ratio, people are paying through the nose. As you can see, the 200 days at 17.16. So we have not been able to get above the 200-day on Amazon, and that's not constructive. So again, keep an eye on the 1700, 1600 area. It could stabilize in there, which is what it's trying to do. But if you start blowing out the 1500, 1600, you see the 50 days at 1567. If you start blowing that on the downside, that's not so good. Again, another troubling thing on the retail side was Walmart this last couple of weeks. They announced some pretty darn good earnings, the best in 10 years, I think. And Walmart went way up to 103, maybe even 106. And but didn't last. It gapped up and then it filled that gap. See, it gapped up to 105 there, and then it filled that gap right away. So again, sometimes people don't think that is very positive. And look at that PE ratio, 43 to 1. That ain't a cheap stock. So the bottom line is that again, valuations do matter. They mattered during the dot-com boom, where there was no earnings and everybody said we're only looking at eyeballs. And again, eyeballs, when they go away, that means the valuation went away, and that's why you get crashes when there's no earnings, or the earnings don't really justify the valuation. So you got to be careful when you get into companies that are highly valuated. Another one recently in the news, because that kid blew out his sneaker down at Duke, is Nike. And that one got hit the other day because of that. But there's some pretty good fundamentals to Nike, but it is also in the double top area. Let's take a look here and see what we got. Yeah, it's back up from the other close, but people are talking about the fact that it is near its all-time high here of 85. So if it can blow above 85, again, it could keep going. But let's look at the 200-day average, and that could give you the warning signal on Nike. Nike 200-day average, I'm giving it to you right now, is at 76. That's not too bad. That's what well, when it hit its high of 86, well, that was last September. So obviously it's come way, way back. Look, way, way back. So again, where are we now? It's not that extended. You're only about 10% above the 200-day average. So there's nothing telling you there. It could have more legs on it. Again, obviously they really have a big corner on the apparel market and the sneaker market, etc. Okay, let's take a look around, because here are the 4 sectors I've been trying to show you that have been kind of pretty good places to be. And one is the financial area. Let's take a look at the banking index here. And there we go. I'm going to be using an ETF called the Vanguard Index. So, you got plenty of ETFs out there. I'm just picking one, no special reason. Vanguard's a very big outfit, so basically I'm familiar with what they do. Again, big rally from 55 to 67. Again, you're looking at a situation. Let's take a look at the averages here. Now, these would have all the big banks in it, the JP Morgans and all the big financial companies in it. And so this is a sector that has benefited, and people do believe if there's further upside to come, this could be a situation. And I'm going to run through a few sectors quickly here for you. Okay, moving averages, 61 and 67. Again, you're still inverted here, and that's, technically for me a little bit of a problem. In other words, that's what makes me a little skeptical of the rally, and it makes me feel like consolidation or a pullback is a high probability, because the technicals on the moving averages are very sloppy. So only time will tell. But the point being is that could we have a little bit more upside? I think so. Could it pull back and consolidate? I think so. Is there going to be a collapse in the market? I don't see it now. But of course, when I update every Friday, we should be on top of it before it occurs. With regards to the banking, again, looks like it's had a good run. It pays a decent dividend. And again, it's one sector that people are talking about. The other couple of sectors that people are talking about would be healthcare. And let's take a look and see that. VHT is the healthcare ETF. And again, the demographics are great for healthcare, so that's why people are very interested in it. And again, a big collapse down there in December, and then right back up again. So again, healthcare has had a big rally. It's again probably right around the 200-day average or a little bit above it. So that's a sector that people believe might be a decent sector to be in. Second one, a third one would be in the energy area. Again, the oil prices have rebounded quite a bit, and the earnings coming out of some of the oil companies have not been terrible. So, looking at the sector on that, you can see it's also had a big run from the bottom of 71. And again, it's not as overbought, so that's why people think there's some value to it to the upside. I tell you, the other one, of course, would be in the area of industrials, but they've had a big run too. Let's talk about a couple of sectors that haven't. One is materials. Now, Vanguard's material ETF. See, these are like, again, energy hasn't had a big move, and people are thinking optimistic on that. Materials have had a pretty good size move, but they're nowhere near the high, but they're extended. But this is another area people are kind of constructive on, is the materials. And then the other one that I am a believer in is in the metals, because of the fact that the dollar, which I'll show you in a minute, could be at a higher end. And I've been showing you know, there is, to give you an idea, investment grade bonds maturing in the next, so between now and 2023, 48% of all of them are going to have to be refinanced or retired. Now, this year alone, 600 billion. Next year, about 700 billion. Next year after that, 800 billion. That is an avalanche of debt coming to the market that has to be retired or refunded, and that could be problematic. And if if the Fed is going to have to get involved with any kind of support of that market, that could be printing. And that's where the gold is starting to get its bid. Can you see? I've been talking to you about this in 17. Then I said it might have some resistance at 20. It blew that out. Then I said it could have some resistance at 22 because those are the former lows. It blew this out. So it's had a big run. There's a gap there, obviously, and another gap here. So pullbacks could occur. But as part of your portfolio, I don't think it's a terrible, terrible place to be from the standpoint of part of a portfolio. Again, one stock in particular that I've been eyeballing since it was $10, and it looks very cheap to me. If there's going to be a run in gold, you got to get above 1,400 on the spot price. If you get above 1,400 on the spot price, I think you got a good deal going. Okay, and this one could be one that goes. Again, you're at, I told you, I was telling people about this at 10. Why? We ran up to 12. We come back to 10. This is Freeport McMoran. They just bought Gold Corp. They're huge as far as owning reserves and having supplies of gold. So obviously, and some decent prominent investors are involved. Again, this is my opinions. So anyway, you double bottom down there at 10. You blew out that number there. That's very constructive. I'm going to show you a 10-year graph to put it in perspective. And I was looking at some of the call options going out to 2021, and like the 15 and the $20 calls were going for like about under $2 on the 15 and under $1 on the 20, going out to January of 2021. Again, that's a risk, but it's a limited risk when you buy the call options. If it never happens, you're going to lose the entire premium plus commissions. But if it does happen, you got leverage and limited risk. Now let's take a look at the 10-year graph so you get a little idea if this thing can get on its bicycle, why it might be something to monitor, and there could be a lot of real estate above. Again, they just bought Gold Corp, and that puts them in a very good position supply-wise. Okay, so you can see if it breaks above 20, that could really open the floodgates. This thing used to be at 60, then it used to be at 40. Now, it went down here during some kind of a panic low, and that was when gold, I think, was around 1,000 or so. And it went down to about, 6 or 8 down there. Okay, but now, you went up to 20, you pulled back to 10. That seems to be the big support. It looks like it's trying to turn out. And if gold breaks above 1,400, I would be very surprised if this thing doesn't get on the bicycle. So again, this is a company, again, because they made that big purchase, that might be very worthwhile to keep an eye on if you believe that you could get a rally in the gold. Again, I happen to believe that companies are hiking prices right now. And I happen to believe the inflation numbers may pick up quite a bit. And on my view, there's zero discounting of inflation in the bond market or in the dollar. And if inflation numbers were to pick up, because the entire world is saying there's no inflation, the entire world seems to be saying that there's no inflation is not a worry. And when you get that kind of consensus on an opinion, it's generally time to look at the other side. And so basically my feeling is that there is a risk of inflation, and the Fed could come back into the picture in the second half of this year. If I'm accurate, then I think that this gold would have some future to it. That's why, as part of a portfolio, it might make sense. Don't go hog wild, because if it doesn't happen, and then they won't go. Here's your dollar index real quick. Let me get into this. And there you go on the dollar index. Again, it went up towards 98 again. And if it can get underneath, this is a 10-year graph. If it can get underneath the 94 area, I think that would be an indication the dollar's having some weakness. Okay. Again, a couple of other things. If you want to email me, I could give you an update. I think there's some opportunities I've been talking about in China with Alibaba, with Baidu, with Tencent. And I think there's other things going on as far as a few other different sectors. I haven't had time to hit today, but next Friday I will hit some more there. Again, there's been a big turn in the market, and I did go over some of the technical indicators that are indicating quite positive numbers. But by next week, I think we'll have a much better idea if this market can break through 2,800 or not. And so don't forget to tune in next Friday, and do let your friends and associates know that they could go to OptionProfessor.com, get the link, and get this information free of charge. I hope this was helpful today. I look forward to talking to you next Friday. This is Jim Kenny signing out. Until then, have a good weekend and a good week of trading, and I'll be back with you next Friday. Good day, everybody.